Well, good morning and welcome to the Reserve Bank. With me I've got Grant Spencer, who I'm sure you all know. He's the Deputy Governor and Head of Financial Stability. New Zealand's financial system continues to perform well, but it faces increased risks from the deterioration in the outlook for global financial stability and from developments in the dairy and housing sector. Global economic growth has softened over the past 6 months, and financial market uncertainty has increased. Globally, interest rates are at historically low levels, and this is encouraging higher leverage and leading to a build-up in risk in international asset markets. This creates risks for the New Zealand banking system, which relies on the global markets for some of its funding. The dairy sector faces a second consecutive season of weak cash flow due to low international dairy prices. Prices have recovered since August, despite the last 2 auctions, but many indebted farms are coming under increased pressure. This pressure will increase if low dairy prices are sustained or dairy farm prices fall significantly. House prices in Auckland have increased strongly, and house price to income ratios in the region are now at levels seen in some of the world's most expensive cities. Rising investor activity has been an important driver of price developments. A sharp downturn could challenge financial stability, given the large exposure of the banking system to the Auckland housing market. While it's too early to judge the effect of recent policy changes, they are expected to help moderate pressure on Auckland house prices and improve the resilience of bank balance sheets to a housing downturn.
Currently, the banks do hold strong capital and liquidity buffers and have maintained their profitability with further reductions in cost-to-income ratios. Lending growth has picked up and is being funded mainly through higher domestic deposits. The banks are working with those dairy farmers experiencing difficulty, and it's important that they continue to take a medium-term view when assessing farm viability. Losses on dairy exposures are expected to be manageable, but banks need to ensure that they set aside realistic provisions to meet likely increases in problem loans. The new rules in Auckland on Auckland residential investor mortgages came into force on 1 November. The bulk of these loans are now required to have LVRs of no more than 70%. Banks are also now required to put all residential investment loans in a separate asset class and hold more capital against these loans. LVR restrictions have been eased outside of Auckland, where housing market activity has been more subdued. However, the bank is closely monitoring the recent rises in house price inflation in some areas such as Hamilton and Tauranga. The Reserve Bank has a number of other regulatory initiatives in train. Public consultation has recently closed on a stocktake of banking regulations, and the summary of submissions will be published shortly. We've recently released a consultation paper on changes to the outsourcing policy for banks, and we're also well advanced on an improved oversight regime for payment and settlement systems.
So thanks very much. We're very happy to take your questions.
Governor, you'd mentioned in the report that the credit losses on the dairy sector look manageable for at least the 5 biggest lenders from your initial modelling. In terms of the Auckland housing market, how does that fare? I mean, if you were to look at a sharp downturn, are the lenders capitalised enough to deal with that?
In terms of the the stress tests that we've done, and we did a number in 2014, they were certainly encouraging when we did them. And as you know, the banks are well capitalised. Having said that, since we did those stress tests, Auckland house prices are up 30%. And it's not just when you do the stress tests, or the factors that we're thinking about is not just the impact on the financial sector, because as I say, it's well capitalised, but it's also the effect on the broader economy as household balance sheets come under stress. I mean, if you look at household debt to income ratios, they're now at 160%. So if the asset prices that are backing a lot of that debt start declining, then you can get into very difficult situations that will have broader effects on the economy in terms of spending and unemployment.
Just expanding on the stress test. So while the banks will tend to pass stress tests, in other words, they'll stay solvent and maintain their capital ratios, in order to maintain their solvency and maintain their capital adequacy, in those stress tests, the banks will tend to cut back on lending. So they'll retrench lending. And that can cause quite an impact on the real economy. So I think there can be quite a lot of damage from a housing downturn from credit restraint, even though banks retain their capital adequacy.
How close are you to looking at loan-to-income ratios for the Auckland market? Is that something that's in your thinking?
We, in terms of debt-to-income ratios, we're collecting data from banks. We've been doing so for about a year or so. But at this point, we're not considering anything in respect of debt-to-income ratios. We're looking at experience in other countries. There are issues around standardisation of data, for example, between banks. But in essence, we really want to see how the current measures in terms of what the government introduced on 1 October and what we've introduced on 1 November, how they work. But I should make the broader point that, in essence, the housing situation in Auckland is really one of supply. I mean, low interest rates are certainly a factor contributing to household demand, as is high migration. But in essence, the solution is greater housing supply.
Hello, Governor. You had voiced concern about the level of New Zealand dollar in October, and in this report you're saying that it is seen as a significant buffer to the economy and financial system. Are you comfortable with where the dollar is, and what is your, if you could give a level of where the comfort is? Thanks.
I think I'll leave comments on the exchange rate for about another 3 weeks when we come for the December MPS. So thank you.
The comments about Hamilton and Tauranga, how concerned are you about the regions, and if they were to be prolonged increases, would you reintroduce the original speed limits you had with the LVR?
If you look at Hamilton house prices, they're running at around 18%, and Tauranga's around 14%. It's a little bit early to get a feel for what's happening around Auckland and perhaps the house price increases elsewhere. For example, there's a lot of anecdotes that the Auckland housing market has come off, that auction completion rates are less and lower volumes of transactions in terms of the latest monthly data. But it's really too early to tell there. What we think is happening is that activity in the Hamilton market and perhaps the Tauranga market is largely driven, or to a considerable extent driven, by investor-related purchases. And investors basically with housing portfolios in general of less than 3 or 4 houses. So we think that's driving the market. It tends to be at the lower end of the market. So for Hamilton, we think somewhere in the sort of $150,000 to $400,000 range. There's a lot of activity there. But it's too early to say whether we would introduce measures. We simply want to see how the current measures are working.
The amount of stretch in those markets is still a lot less than in Auckland in terms of house price to income ratios, the extent of disequilibrium. So even though the prices are increasing, you'd have to have that continuing over a long period before you start to develop the same sort of stretch that you have in Auckland.
If you look at house price to income ratios for Auckland, they're currently at 9.2. That's a dramatic increase from 2011 when that ratio was 6. It's gone from 6 to 9.2 since 2011. For the rest of the country, it's by and large around 5 on average. So there is greater stretch, as Grant said.
Ian McDonald from Bloomberg News here. Given that obviously low interest rates are a key part of what's going on in Auckland, and it's in terms of RBNZ policy, it's obviously a movable thing at the moment. Last week, expectations that the Fed would raise rates next month increased after US jobs numbers were very strong, and traders here have subsequently reduced their bets that New Zealand would lower rates again. Are you able to comment at all on what kind of impact the Fed's policy move, if it comes next month, might have on your outlook for policy?
I won't comment on monetary policy, not for another 3 weeks or so. I think the Fed had a situation where the markets were not expecting tightening or the first interest rate adjustment to take place by and large until March or April of next year. And I think my sense was that was a concern in the sense that if they did move in December, then that could be a significant surprise to the market, given that there hasn't been an interest rate increase in the US for over 9 years. And so, everyone, I think, was looking very closely at the non-farm payrolls data, and it was up about 90,000 in terms of jobs over expectation. And you also saw compensation of employees pick up to around 2.5% on an annual basis. So, I think what you're starting to see at the moment is long-term interest rates are starting to pick up a little bit. The US dollar has been strengthening, and I think everyone will wait to see what happens with future indicators, and particularly the non-farm payrolls for November.
Governor, to what extent would you say that the rise in investor ownership in Auckland is a direct result of the initial LVR restrictions? And are you expecting, what sort of likely distortions do you expect from the latest LVR restrictions?
I think, initially in October 2013, when we brought in the initial restrictions, there was a reduction in first home buyer share of the market and an increase in owner-occupiers and investors. And then it was stable for some time, but over the past year, particularly since September 2014, there's been a significant, substantial further increase in the investor share. So we don't see that as related to the initial LVR restriction. It's a new phenomenon, and we think very much linked into the general expectations of ongoing shortage and ongoing price pressures in that market.
If you look at the share of first home buyers in terms of overall transactions, when the LVRs first came in, you saw an adjustment in terms of that share from memory of around 2 percentage points. What you've seen in the last couple of years is investor share of transactions in Auckland have increased from about 33 or 34% to around 41%. Now, a lot of that is driven by, expectations about future house price growth, low interest rates, and expectations, which is really my first point, about capital gains. Because if you look at rental returns in Auckland, they're now at historic lows. They're around 3%, whereas for the rest of the country, they're still around or just below the 10-year average.
In terms of further distortion, I mean, both with the initial LVR restriction and the investor, we have been concerned of potential disintermediation or leakage, whatever you want to call it. In other words, lending going through other channels, unregulated channels. But really, we haven't seen much of that at all in terms of the response to the initial LVR restriction. And we don't really expect to see that as a result of the investor restriction either, given our experience over the past 2 years.
To see that you're going to get each of the banks using the IRB approaches to assessing capital to put essentially the same portfolio through their existing models. Are you concerned that there could be a wide discrepancy in the outcomes?
Well, we'll see. This is what we call a benchmarking exercise to assess the differences in the internal risk models of the larger banks. And so we want to try and assess the differences in their capital holdings that arise from the riskiness of their books versus the actual differences in models, which are presently somewhat obscure. So, it's part of our overall ongoing assessment of the banks and their risk management, risk modelling capability. And so, but we don't have the results from that as yet.
You're not willing to speculate on whether there might be a big discrepancy?
Well, we don't expect huge discrepancies, but it'll be a matter of informing our assessment of the prudential standing of the different banks. At the end of the day, if there are differences that are hard to justify, then we have in the past required certain minimum requirements or key fixed parameters within their model. So we have done that in the past, and that's always possible going forward.
One last question. If you, when you're reviewing the number of reports banks produce a year, are you looking at the possibility of introducing deposit insurance?
No, we're not. That's obviously more a question for the government rather than the Reserve Bank. But the bank's position has been not to recommend deposit insurance.
Governor, are you hoping that the volatility in the Asian markets will somewhat ease activity in Auckland, investor activity in Auckland, or are you solely relying on the new LVR measures?
Well, we hope what will address the housing price pressures in Auckland is really increased supply. I mean, you've seen that work in Canterbury, where house price inflation is down to around 4.5%. And there are some in Canterbury that believe that house prices, particularly for low-income houses, will actually fall in the next 3 or 4 years or so. Time will tell on that front. But in essence, what's required in Auckland is increased supply. We'll get a feel for, how the government's tax measures, and particularly the issue around disclosure of inland revenue accounts and things like that, we'll get a feel for what impact that might have over the next period of time.
I mean, just elaborating on that, the October numbers from Ryan's that came out yesterday, it's pretty clear that there's been a reduction in sales in Auckland in October, but it's a very sort of short-term response, and time will tell whether that is a more sustained effect. But we do think there was some bringing forward of housing market activity ahead of the restrictions, particularly the tax restrictions that came in October, the new Bright Line rules for the for the tax on gains, house price gains. Bernard?
Governor, you've mentioned that there is an expectation of capital gains. That is one of the reasons why investors have been more active. Do you think the government should look at the rules around taxing capital gains, or changing the tax incentives otherwise for investors?
As I said, in terms of the Auckland market, you've seen investor-related activity being a significant driver of that market. There was a survey done by ANZ Bank recently where it asked Auckland investors their expectations about future price growth. And their expectations were that Auckland house prices would increase by something like cumulatively 48% over the next 5 years, while our objective is to raise inflation, or keep inflation, or the price level. Let me put it that way: the price level up by 10% over the next 5 years. The government has introduced the 2-year Bright Line test, and it will be very interesting, I think, to see what impact that has over the future period. Capital gains can be effective in some countries in affecting housing pressures and house price inflation, but that's not a universal point. There are several countries that have capital gains tax, for example, that still have significant housing imbalances, that still have significant house price inflation. So it's not a panacea, and I think the moves that the government has done at this point in terms of the 2-year Bright Line test is a helpful measure.
Treasury looked at reducing the deductibility of interest payments for tax purposes. What's your view on that way of approaching the issue?
We don't have a particular set of recommendations. We supported the introduction of the Bright Line test. We thought the short-term capital gains tax, in terms of the previous definition, in terms of intent, did need to be firmed up. So we supported that. We agree that, with commentators, that housing is a tax-favoured asset, and so some of these moves are sensible to have a more level playing field, but we don't have particular prescriptions in terms of the approach that should be taken in terms of an ideal tax position.
Governor, I'm just curious to get your sense. You're looking at reviewing the capital adequacy ratios for the lenders over the coming year. What's your initial sort of thinking around that? I mean, do you see the need to strengthen some of those ratios? I guess you're also noting that as some of the funding of the banks has been rolling out of Tier 1 capital into Tier 2 through those hybrids and preferred share issues. I mean, is that something that you might be looking at within that review?
I mean, on the second one, it's not the review is about overall capital adequacy, I mean, recently there has been a shift from common equity to some of the new alternative instruments, the Basel III compatible instruments, which is perfectly understandable. So that we don't think that's unacceptable in any way. The overall review really, we've had the existing regime in place for some time, so it's probably time to review it. We also have had the Murray inquiry in Australia and the actions that APRA and the Australian government have taken in the light of the Murray recommendations. And there have also been new developments in Basel with review of standardised treatment. There were some new rules out yesterday around loss absorbing capacity for the larger banks. So there's quite a few international developments, and we think it's appropriate to step back and review our own minimum requirements in light of those developments. But we don't have preconceived conclusions about where levels should be going. We don't expect that capital ratios would be reduced, but it's not necessarily the case that they'll be increased. We do think that we've had a pretty strong set of standards relative to the international norms, and we just want to review it again and make sure it continues to be strong compared to international norms.
Governor, could you talk a bit about the dairy debt situation, the need for banks to provision adequately, and whether they're in a position to cope with whatever comes in the next few years? I noticed the modelling of potential land price falls and dairy payouts.
Yeah, if you look at dairy debt, it's roughly, until the beginning of this year, it was around about $35 billion. And the interesting thing was, well, there were two interesting things. One was its rate of growth since 2003, when it had almost trebled, but also the distribution of that debt. 20% of the dairy farmers accounted for half of that dairy debt, so it was a very, very skewed distribution. We think dairy debt has increased by about $3 billion over the past 12 months, and that about half the dairy farmers are experiencing a second consecutive season of negative cash flow. So in essence, we're very pleased to see how the banking system has supported dairy farmers in terms of working capital. We think Fonterra's interest-free loans have also helped out considerably. The difficult scenario would be if dairy prices, and particularly whole milk powder prices, if they turn down again, and as you know, whole milk powder prices hit just under $1,600 a tonne in May. They're now around $24.50, but that's still well down from the peak in February last year of $5,000 a metric tonne. So if you got a situation where dairy prices didn't recover strongly, and you had a sequence of seasons of negative cash flow, and you started to see that affect farm prices as well, land prices, then that would be a difficult scenario. There's no question about that. But having said that, the banks have been very supportive. The expectation of the experts that we talk to suggests that whole milk powder prices will move to some equilibrium level of around $3,200 US to $3,800 US dollars a metric ton in the medium term, and so that's a situation that would be very helpful.
Do you think that the banks have adequately provided for the outlook?
They've, provisions are increasing, so banks are starting to put more provisions away for the dairy business. But we're encouraging them to continue to reassess that and to continue to grow provisions, obviously depending on how the prices and the overall deficit position develops for their customers.
Governor, on investor lending again, are you concerned at all about interest-only loans? And would you also look at changing the rules on or introducing limits on loan serviceability? Because the banks obviously do collect that data from customers on the amount of surplus income they have whenever they're doing lending.
We don't have any plans in respect of either loan-to-income ratios or loan serviceability. In terms of interest-only loans, in terms of their magnitude, let's see if Grant knows, or maybe Bernard.
Well, it's something that we monitor, and talk to the banks about in our prudential consultations with them. And that, they tend to be in with the investment community and also in agriculture, particularly with agri and the dairy sector under the stress it's under at present. Then, interest-only loans is obviously, one of the options they have to reduce demands on cash flows. So it's something we monitor, but we're not about to introduce restrictions on that, but it's something we can potentially influence if we think it's getting excessive in the case of any particular bank. Then that's something we would discuss with them.
Well, thanks very much indeed.